Andre, thanks for joining. This is a conversation as much as an interview as such, but we're wanting to hear from you more than me. Charter Hall, the birth of Charter Hall, your experience here in Australia before bringing it together, your role, partnerships and the rest.
Wow, that's a lot of history.
It's okay, we got time. We got time.
Well, I immigrated here in 1986 from South Africa, and I spent the first 2 years essentially running Leighton Properties as Director of Operations. Leighton's had actually brought me out to Australia. They and that was very interesting. At that time, whilst I was running that business, we employed a young fellow as a work experience student by the name of David Southern. And then I had an approach from Cedric Fuchs, who wanted to move into the real estate business. He'd been in insurance prior to that. And I interviewed him and I said, look, I need somebody to market a specific building that we're developing. It's a very large building, which was going up at the same time as Grosvenor Place, and it was similar in size to Grosvenor Place. And I needed a marketing person for the leasing. But I said, you know, you're a South African, I'm a South African. I don't feel comfortable employing you. So you go and see Wal King, and if Wal's happy with you, I'll employ you. And that's what happened. So that's how I met Cedric and David. The one worked for Leighton Properties as a work experience, and the other one had just immigrated and wanted to work. So that's how we got together. So I ran the company for a couple of years. Was very uncomfortable with the culture of the business. Didn't suit my modus operandi, primarily because when you emigrate, you have one very, very valuable asset, and that's your reputation. You can't afford to blot your copybook at all. And I wasn't very comfortable and decided to move. And I was approached to run a company, a funds management group in Melbourne. I didn't move to Melbourne, I stayed in Sydney, but ran the company from here. And of course, Cedric and David said, well, if you go, we're going with you, which they did. And then 2 years later, I decided I was going to leave and start my own business. And they said, well, if you leave, we leave too. So that's how it all came about. So we started the business in April 91.
So the business in Melbourne was funds management, still property?
Yes.
Yeah.
Yes. Oh, absolutely.
So
yeah.
you were sourcing property deals?
We had a real estate fund, and we had a development arm, and we had a mortgage arm.
Okay. Which company?
Heine. It was the Heine Group. And that was listed, and I was CEO of that, and then decided in 91 I was going to leave to do my own thing. David and Cedric said, well, you go, we'll go with you. So I started, firstly, I constantly get asked where the name Charter Hall came from. Okay.
I know the story you've told me, but tell it again on camera.
We were sitting around one day deciding what the hell should we call this thing, and I came up with the idea that we should sound like we've been long established, been around for 100 years, and something sort of very British, and absolutely thumbsucked that name. I have no idea where it came from. It just came out of my head, and that was it.
It's a Harry Potter moment.
It was a Harry Potter moment. And then what happened was, so we started the business. David was a very young guy, and obviously Cedric and I had a few bob, and we decided we'd fund the business. So Cedric and I actually started the business, in reality. We were 50-50 shareholders. David we had on a salary. So I suppose he was there at the beginning, but strictly speaking, there were two founders, if you talk about risk capital.
Yeah.
And then over time, we gifted equity to David.
And the intention was always to run it as an integrated property development funds management business.
But if you think back, I mean, we're now sitting here in 2015, we've had 25 years of growth in Australia. And if you think back to the year I started it, that was the last year of recession, or that was the year of the biggest recession, the last big recession in Australia. So it was very, very tough times. It was the time,
I went overseas at the time. I went to Malaysia in '92, and Australia was very flat.
Very, very flat. I mean, you may recall there was, talk about Westpac being in. Well, Westpac did have financial difficulties. Right. I think in total they had something like a $10 billion bad loan book. Yeah. They had a subsidiary called AGC, if you remember that, which went insolvent. Correct. Or it was folded, and it was just.
Tricontinental, there was a whole
that's right, a whole lot. Yeah. And so when we started the business, there was no way in the world that you could do any developments. I mean, it's the last thing we needed in Australia was some more space. Yeah. So what we did...
More speculative space, yeah.
Or certainly speculative anyway. So what we did was we started advising a number of the banks. And
in respect of their property holders.
Yeah, in terms of how to get out of their, to handle their bad books, because they didn't want to foreclose. So we actually advised many of their mortgagees. We advised the banks, and we did a lot of advisory work. So it was a fee for service. Always with the intention, of course, that when the time was right, we'd go back into development and funds management. And
this is what I love about business people like you. You're nimble. You just got to work something out to make it happen. And if you have to go into advisory, you go into advisory, even though that wasn't your plan.
Well, absolutely. I mean, we needed some cash flow. So I mean, it was a no-brainer. I mean, we had no alternative. Yeah. Real estate's what we knew, so why not use the expertise?
That's right.
So that's what we did. And in doing that, we actually found our first development opportunity in one of the portfolios of one of the banks. It was a site, and we acquired that.
No conflict, no interest in conflict.
No. It was completely arm's length thing, and that was not a problem. But of course, we didn't have the equity. So where do you get equity? So we went off and spoke to a number of high net worth individuals that we knew, and they backed us, and they did for a number of years. And that was really the beginning of the development arm of Charter Hall. That continued from about 91 through to 97, where we were using high net worth private equity.
Individuals, right.
And then I got, I was sitting around one day and I said to the guys, we need a more permanent source of capital. And I came to the conclusion that what I needed to do was to tap into the super funds. Nobody had done it yet. We created the first real estate joint venture super fund, the first joint venture developments funded by super funds in Australia. I knew that I didn't have the credibility to go off and speak to the likes of, State Super, Uni Super, Equip Super, and so on. They'd say, who the hell are you? And I knew I needed a partner. So I approached Lend-Lease and I approached AMP, and they both agreed to support, to be a joint venture partner with us, if you like. So we would produce the expertise, they would produce the introductions. And I selected to go with AMP primarily because I thought, Lend-Lease is in the real estate game, it'd been far more interference, blah, blah, blah. So we went with AMP, and we raised, I can't recall exactly, but the first fund probably raised a couple of $100 million.
Was this in MLC days still with Lend-Lease?
No.
No, so it's post-MLC.
It was post-MLC. I think MLC had disappeared.
To NAB already, was it?
Yes, it was already in NAB.
Yeah, that's okay. So
No. No. MLC was still in Lend-Lease.
Yeah, so that's what...
Sorry, not in NAB. Lend-Lease sold it to NAB later.
That's right, so they still had the super fund business there, that's right. So
they had that, but
made sense. But no, I totally agree with it.
But Lend-Lease
had their own development capacity.
Exactly, they had their own development capacity, their own funds management, they had GPT, and so on.
Right, that's a GPT as well. Yeah.
So I thought that, AMP would be a better partner for us. And it worked very well. So we jointly marketed this concept, and we called them the PDPs, which was Property Development Funds. The PDP number 1, and it became a series of funds. The first fund raised,
PDP doesn't go Property Development Fund. It goes
PDF, then Property Development. Yeah, that's quite right. PDP, Property Development Portfolio. or
whatever.
It was the PDP, but I would say Property Development Portfolio. Yeah. And we raised some a couple of $100 million initially. The deal was that we would give the funds a targeted return. Obviously, we would earn some fees along the way.
Yeah.
And those were our fees. When I say our fees, Charter Hall basically earned the fees because we did all the work. The deal was that we would reach a hurdle and then have an 80-20 split on the profits thereafter, which we shared with AMP. And we did that successfully for a number of years. I can't recall how many, and difficult to know, but we would have probably raised $1 billion or in excess of $1 billion over a few years of equity, which we used to do developments. AMP then decided they could do it themselves, and we said, fine, well...
And this I think was the time we started talking to you.
That could be right, yes. It would have been a similar sort of time. So now we're in about 2002, 3-ish.
Yeah, that's right. And we'd started looking at property development in our own right. We were looking at doing joint ventures with another property developer, and then we thought, oh no, we don't want to necessarily do just individual property developments. Let's try and do some business with a property developer. Let's take equity in a property developer.
Right.
Yeah.
Yeah.
So we started.
And that's right. It would have been similar times. So we would have run for 5 or 6 years with AMP on those various funds, and so it would have been around 2003. They went off and did their own thing, which lasted a few years and then folded. It didn't work.
Surprise, surprise, because I mean, an institution like that, I mean, you've got to be nimble in property development.
Well, basically, they bastardized the model. What they did was they started funding undercapitalized builders and developers. So they weren't actually doing in that fund, they weren't actually doing developments per se, but they were going up the risk spectrum. And it didn't really work for them, and they folded the whole business eventually. And of course, we by that time had very good relationships with the super funds, and we didn't even have a hiccup. The funds still continued supporting us. And to this day, they still continue to support the company.
But you wanted to, you had it came about, our introduction to you came about through an article that was published in the Fin Review, where you were talking about looking at going public.
Yes. Now, I do recall there was an article in the Fin Review, and I do recall getting a phone call from Transfield as a result of that article.
That's right.
I can't actually. I was thinking about this. I can't actually recall what that article was about. I think somebody was speculating about us going public or something.
Right. Yes, that's right. Whether it was you or yourselves or the journalist or whatever. And we thought, oh, that's interesting.
Yes. Well, we weren't ready for a listing, obviously, at that time.
No, and I suppose we came along.
Yes.
Thinking that there was that opportunity. Like we spoke. We all understood that was the situation. So we ended up buying in 50%, and then we continued working on trying to understand whether an AMP could become more a fixture again in that sort of arrangement. And at the end of the day, you'd continue to do more and more of those funds with
with the super funds.
That's right. And really, the question of going public was just to simply ramp up the capital base.
If I recall correctly, what we agreed as a business plan when you came on board with a 50% investment was that we would list the company in, I think we sort of said we'd build the company to into a bigger business and try and list within sort of 3 to 5 years. I think that was the strategy.
Correct.
But then I recall clearly we sat down around the table one day, and I think David Gonski was there, and we all looked at each other and said, you know, guys, the time's now. And so we brought the listing forward very quickly. It was I think 18 months after you came in, we listed.
That's right.
So that was very much quicker than we anticipated doing it. What we then did was scramble around, because whilst we had a very, very good development arm, we didn't have enough funds under management. And really, I think the feeling was, and probably still is today, that you want to list at least with an 80-20 split, meaning 80% of your income is coming from a regular cash flow, such as your funds management, and 20% from the more speculative development business. We wouldn't say exactly the opposite, but certainly we went 80-20. And we then scrambled around, if you remember, scramble's probably not the word, we worked damn hard to source a number of buildings so that we could get the funds under management.
And this is where was David Harrison?
David Harrison at that time was at Savills.
Yeah.
And I, it was clear that David Southern was going to be a successor. I had some doubts that he would run the whole business, and I knew that he would get on with David Harrison. They'd gone to university together, they were good mates. And if I was going to bring somebody into the business to work either as a joint CEO or as the CEO, it would have to be somebody that David could get on with. Yeah. And that was the rationale for bringing David Harrison in. Yeah. So he joined the company from Savills. The two Davids were there, and then if you recall, I said, well, we'll go to the listing, but I don't want to stay on as CEO. I don't know if you recall that. Correct, that's right. So we made that very clear to the investment markets.
That's right. So the joint managing directors.
Yeah, joint managing directors. I agreed to stay for 3 years, and really after I think 2 years, it was time to go. And it was the right time to go. I mean, in terms of the financial decision, because it was just before the GFC. It was. Yeah. I think that was, that's I was beginning to clash a little bit with the board, because although I didn't know it was going to be called the GFC, you had to be blind Freddie not to know it was going to come tumbling down. It had to. It was obvious, globally. With properties in London selling on 1% and 2% yields, and interest rates were significantly higher at that time. It just didn't make sense.
It seemed to be, to us at Transfield, an expertise that you had refined so much better than many others in the field. And what would you say was how did that come about? I mean, is there an easy answer?
I think, I see it even today, I still see it. I see a lot of people who claim to be fund managers and they're buying assets, and let's say they get the pricing model right, and they pay the right price for the asset. They don't work the assets. It's not a passive business. You don't buy an office building and just let it sit there. And that was something we were always very, very fixated about. We had full-time leasing people. We didn't try and take the leasing activity away from the agents. We always paid the agents the full commissions. But we had our own internal leasing people who would try and lease it if they could, but would be very much on top of the leasing agents. And so we were very active, we were very hands-on. I think the other thing is because we had a development skill, we were also good at maintaining the assets, adding value to the assets, physical value.
So but apart from developing the properties in the first instance,
yes,
which is no mean feat in its own right,
But we also bought assets.
Yeah.
I mean, into the funds.
Yeah, so but you also developed the greenfields.
Oh, absolutely. Yeah. I mean, that was the genesis of the business, was greenfields development.
Yeah.
Absolutely. So it was...
And in fact, you didn't have any particular preferences, whether it was greenfield, brownfield?
No, there were no preferences.
You're capable and adventurous enough to do
that. Oh, absolutely. I mean, personally, I love the creative side of it. Yeah. Obviously, not just the financial creativity, but I enjoyed the design aspects.
And that's come through because it's a quality. Your products are quality products.
Yes, most of them are. I mean, you have to be careful that you don't sort of over-specify for a particular market. Yeah. So, and it was actually, that's quite an interesting point you raised there, because I felt we were never good at producing low-cost housing or even relatively inexpensive housing. And so the company only ever developed a handful of residential did a handful of residential developments,
But
and they were all very top end.
Yeah, that's what I mean.
Because we wanted to be able to put that quality into them.
Yeah.
So there's a building in Bellevue Hill which we developed, and
right.
I saw the building this week, and I can't believe it's 12, 13 years old, and it's in very good condition. There's a massive demand to get into that building. People there's a waiting list to buy apartments in that building. And then of course we did the Wharves down at Piermont.
Yes.
Wharves 8, 9 and 10.
Yeah,
and those
likewise, there's demand there too. I mean,
and they were expensive. And yes, that's right. And so I just didn't feel we could ever compete with some of the very established.
But that reflected probably as much your inclination, as you say, your love of design, your interest in good design. It came out in
well, hopefully, I'd like to think so. But there are a couple of buildings I'm embarrassed about.
Well, but there's always going to be some outliers in a portfolio. But generally speaking, Charter Hall is well regarded because of its quality.
Yeah, well, that's nice to hear. But I think that was the aim. That was always the aim, to try and do it well. The other thing that we really did do is pretty much stick to our knitting. We understood commercial, we understood industrial, and residential high-end, as I said. We never, ever did, apart from some bulky goods, we never got into retail.
Yeah, that's right.
We didn't have the expertise for that. It's a completely different ball game. Building a shopping centre is one thing, but actually you're running a business.
That's right.
You're not running a property, you're running a business.
Correct.
And it wasn't our expertise, and we always try to avoid that, except, as I say, for bulky goods. We were very early bulky goods developers.
But I suppose also the sort of product demand from the super funds was more inclined to those more, how would you regard them as, less volatile. I mean, retail can be volatile, and I'm not sure. Maybe that's an overgeneralisation. But did you were obviously trying to get a match happening with the super funds and your product, and what was that match? That match was certain returns, but they were meant to be.
They were product specific.
Correct.
They were office buildings.
They weren't speculative or highly speculative.
No. No.
Yeah.
No. I mean, we would take leasing risk. Believe me. I mean, if we had a particularly good site and we felt the market cycle was with us, we would develop a speculative building. But invariably, we managed to pre-lease either substantial amounts or fully pre-leased buildings. So we would de-risk.
Yes, you would. Before building it, you would de-risk it.
Or during construction.
Yeah.
What happened during the GFC is that Macquarie Bank, who, by the way, if you recall, did the listing, they underwrote the listing, and we were fully subscribed, so there was no need.
No risk.
Yeah, there was no risk to them at the end of the day, and we developed a very good relationship with them. I'd always been very wary of Macquarie Bank, and actually gained and developed a lot of respect for them to the extent that I still do business with them today. And they were very professional and very smart. And their advice and their tax structuring, it was all pretty good, it was spot on. And Yelta Bakker, I don't know if you remember him, who was at Macquarie Bank at the time, worked on the transaction, subsequently joined Charter Hall, became the CFO at Charter Hall. And then during the GFC, when Macquarie Bank decided to get rid of all its funds, it was pretty good damn match with Charter Hall. Yelta, who's had a good relationship with Macquarie, was now at Charter Hall. It made a lot of sense. So obviously Charter Hall had this huge jump by acquiring all those funds. And today the company is about just under 13 billion under management.
Yes.
So that's
and which is ranking up there in terms of property trust.
Oh yeah. It's in the top.
Yeah.
It's in the top performers and also in the top few in size. But I think if we think back to the Transfield involvement, it was a huge boost for us in terms of credibility. in going out to people and saying our 50% shareholder is Transfield Holdings. I mean, that was incredibly valuable to the company, in opening doors, in borrowing money, in giving people confidence that we could deliver, etc. That was an enormous big step.
That's nice to hear, and we were we were confident that we could add something also with the listing, because we'd just been through the listing with Transfield Services, so we had an understanding there. We helped put together the board. We suggested some people.
Correct. Yeah.
Kerry Roxburgh was the original chairman. Well, it seemed like it worked out. I mean, I think we were pretty happy all around. I mean, there might have been.
Well, if we weren't happy, I don't think we'd be sitting here today, would we?
That's true.
We'd probably be.
That's right. We wouldn't be having this discussion.
No, unlikely. But there were good times. I mean, they were pretty exciting times, and
I mean, from your perspective and from our perspective, we can say we got out sort of top dead centre,
Well, we definitely did.
Yeah, I mean, when I say got out, like you, we could see something happening here, and we managed to arrange our affairs in Charter Hall properly. Unfortunately, we could say we did that everywhere else, but it worked with Charter Hall.
Yeah. Well, I think also you went on to invest in something else shortly after that.
We bought into this solar energy business.
Solar energy business, yeah, with some of the proceeds, yeah.
Yeah, which is another story.
Of course, that's another interview with someone else. Yeah, absolutely. Yeah, no, they were good. They were, it was exciting times. It was fun. I have to say the relationship was very easygoing as well. I didn't find that Transfield were trying to interfere in the day-to-day running of the business, which was great. There were, a financial investor. That's the reporting was there, representation on the board, correct. But it was, you did allow us to get on and run the business as we saw best, and that was great, because I do think that sometimes doesn't work like that. It can
be problematic.
It can.
We understood you had the expertise from day one. It was not for us to second guess you. Yeah.
Mm-hmm. I think the smart thing we did, both of us, or jointly, was to bring that listing forward as quickly as we did. We would have lost the opportunity. I mean, had we continued to grow the business to bigger and bigger and bigger, the opportunity would have evaded us for probably 8 or 10 years.
Yes, and having because you need to have a certain scale and credibility to get to the listing.
Yes, which we developed very quickly.
We developed quickly because you're also getting the funds under management.
Yep.
Yeah.
Yep.
Yeah.
We had a good mix, if you remember, of both private and institutional support.
Yeah, that's true.
It was good. It was a good balance. And indeed, I don't think many people speculated in the stock.
No.
Post the listing.
Yeah.
Most people stayed in for the ride.
Yeah. Got a little bumpy through the GFC.
Don't think.
Everyone got bumped. Yeah. And this was the problem with having the listed properties. We had the discussions about campus living. We were looking to seed campus living into you, but for whatever reasons, I don't know that we ever actually talked about that. I mean, can you recall what was your thinking about that?
I was concerned about the new developments that were proposed in the US. I thought that the old existing stock would continue to do well financially, and was concerned about the rollout program for the new stuff. That worried me somewhat. I was also concerned about the New Orleans situation. If you recall, the New Orleans had...
Was it Katrina? Was it?
Yes, it was Katrina, I think.
Yeah.
And that had wiped out the stock, and I was really had some issues about that. And I think those were the major issues for me. It was just that...
You weren't concerned about having to manage a student property portfolio?
No, not at all.
No, I wouldn't have thought so, that's right.
No. It was... I wasn't sure that it would maintain our growth trajectory, or whether, in the sense of being accretive,
yes,
or whether it would dilute. And I thought it would dilute, for a period of time at least.
Yeah.
And I wasn't sure that in the early days of our listing whether we should be taking the risk on things that could be dilutive.
Yeah, yeah.
So that was my logic on that.
But the fact that it was diversified business didn't worry you? The fact that it was a different type of business?
No, that didn't particularly. I mean, it's certainly not just a pure real estate play, because it's very hands-on, a little bit like shopping centre. But I thought that was quite manageable. I did go over to the States and look at the assets. I don't know if you recall. I did go over and had a look at all of them.
Yes, that's right.
And
that's right.
Some of the old stock, whilst it wasn't what contemporary student accommodation looks like, it had a very good book value, a very low book value, very high returns. And I think the tradition, my feeling at the time was that the tradition of first-year students in the US going to university
was underpinning that.
Totally underpinned it.
Yeah.
Yeah. And those older style, if you like, dormitory type. They weren't quite dormitories, were they? They were sort of single-loaded corridors or double-loaded corridors.
That's right.
Yeah, but they would continue to do well, but I was a bit concerned about the new stuff. As I say, it wasn't the brand or the whatever that worried me. It was just where was Charter Hall at that point in time, and what impact could that have had, and should we at that early stage in the listing of this company, should we take that kind of risk? And that was really more my motivation for backing away from that.
Yeah, that's interesting history. Campus living is, and it started. The discussion with you just started now, talking about how the Charter Hall business suffered through the GFC because it was a listed property development business or property business, and it went down with all the other real estate trusts, and whereas the campus living business unlisted. No, there was no impact because there was no one to impact in a sense.
Sure. Sure.
So we're lucky.
In a sense, that's
we're
fortuitous then.
Yeah, fortuitous.
Except the students didn't stop coming, did they?
Students didn't stop coming. That's right. Yeah. Whereas maybe the tenants did. Yeah.
Well, that's true.
Yeah.
I guess that was my big issue, Luca. When I decided after 2 years it would be best to go, I was disagreeing with the board in terms of what the future of the world looked like, and I wanted to cash up and sit on cash.
Yeah.
And they wanted to continue developing. I think, in retrospect, I'm sure they'd agree it would have been better to cash up, and had the buying opportunity. And that's exactly what I did for myself privately.
Yeah.
I cashed up, not just Charter Hall.
Yes,
everything.
that's right. Yes, that's right.
So
well, good, Andre. I think that's probably
okay.
Yeah.
Sure.
Thank you.
Okay, you can have to.